Hello, everyone, and welcome to your Glassnode on-chain update for week 20, 2022. Now, we saw a seriously chaotic week for Bitcoin and the cryptocurrency market. This really was one for the history books. We've titled this Unstable Coins because that's more or less exactly what we saw. We saw that the LUNA project hyperinflated the supply. UST collapsed, so these two are both interconnected. Tether USDT also had a de-pegging event, which started to really spook the market. And as a result, we had a more or less major sell-off across the entire market, brought down Bitcoin down into the 26,000s. So a very, very serious week, something that is going to be in the history books. There are going to be a lot of ramifications from this. And what we're going to do today is really explore the mechanisms of what happened and understand a bit about the market structure that followed on from that. So as I mentioned, it was a pretty chaotic week, and we're going to try and assess this from a number of different angles. Obviously, the big talk was about LUNA, and we're going to discuss the mechanism as to what actually happened here. Essentially, the LUNA token has hyperinflated, and this did result in the sale of about 80,000 BTC as the LUNA Foundation Guard attempted to defend the peg for UST, which ultimately was unsuccessful. Now, we're also going to look at the stablecoin market and some of the impacts of the Tether, the USDT De-pegging event. We're going to look at what happened in terms of realized losses when you get these large-scale events. It's generally accompanied by lots of people selling at a loss, including the LUNA Foundation Guard, who realized some $730 million worth of losses on their coins. And that doesn't include when they actually traded them for UST, and that continues to decline in price. So it only accounts for their on-chain realized losses. And we're going to look at Bitcoin and how it traded down towards its realized price, which historically has been one of these very, very sound and strong bull market supports. And there is a lot of logic and reason behind that. So as always, just before we get started, please do give us a like, a share, and a subscribe. It does help people get to this channel. And I do hope you enjoy this edition, as it's going to be an interesting observation of what actually happened. So here we are in our week 20 unstable coins dashboard, and you can see that we have traded down. This was a fairly nasty week. It was about 21.2% onto the downside on the week alone. So a very, very significant trade down at the moment. We did get down to a low of about 26,500. We have since recovered back into the 30,000s. So we're kind of tussling around that 29.9 to 30,000 level. So we have seen a bounce, but as you can see, the price chart is continuing to trend lower, and we really are trying to find where that support may be. So on to the first phase, and this is probably one of the more interesting events we've seen in this market in some time. What we essentially saw is the LUNA project in its entirety more or less collapse. So the mechanism here, I'll give you a very brief overview. The way that this stablecoin works is what we call an algorithmic stablecoin. So it's not trying to back it with US dollars or some kind of fiat-based collateral like USDT or USDC. It's not like something like DAI, which is then using some kind of crypto over-collateralization and a liquidation mechanism. Essentially, it's a debt instrument. What an algorithmic stablecoin does is it tries to back it with some other mechanism. And in this instance, it was essentially the burning mechanism to and from LUNA. So the system is essentially structured so that you could always exchange UST for $1 worth of LUNA, and you could always exchange $1 worth of LUNA for UST. Now, the challenge here is that we have a system that is very reflexive. So even though the price of these things can change in the market, the protocol always saw it at a value of $1. Now, the challenge here is that when there's demand for UST, and there was this anchor protocol with a 20% yield, that was bringing people in to try and obtain that. So people had demand for UST, and that burns LUNA into UST, which lessens the supply of LUNA and generally results in an upwards pusher on price. Now we can see here that LUNA, which is here in the red, so this is the price chart. We've got LUNA in the red, which is, you can see was trading up here around $80, kind of at the start of this whole saga, whereas UST was trading, holding its peg up here in green at $1. Now what we then saw is that same reflexivity that gives LUNA the upside momentum, as you would expect in the world of physics, equal and opposite reaction. When the price of LUNA starts to fall, or the UST peg starts to fall, as we started seeing here on the 9th of May, what we generally see is that you're going to have reflexivity in the other direction. So what happens is that as the UST supply gets burned and the Luna price falls down, it mints an increasing amount of Luna with every single burn. And that puts a downwards pressure on price, which therefore creates this system even further. It becomes what we call a death spiral, where essentially the more that Luna falls, the more UST gets burnt into Luna, which inflates the supply, which burns more Luna. And you get this process where the thing essentially collapses under its own weight. So over the span of 36 hours from the start of this de-pegging event, we essentially saw Luna fall from some $80, $60 all the way down to 0.1. So we got down under 10 cents. And from that point onward, it's essentially collapsed down to the point where we now have 4 leading zeros and then a 1. So really, this thing essentially went from $60 to 0 over the span of about 36, 48 hours. So a very, very significant collapse. And we can see that the UST peg failed to be held all the way down. At the time of writing yesterday, it was trading about 12 cents rather than $1. As I checked this morning, it was closer to about 7 cents. So this thing is continuing to devolve. Now, on the right-hand side here, we have the Luna versus UST supply curves. Again, Luna in red and UST in green. What we can see is that on the 9th of May, so the UST supply, and there's one thing I want you to note here, the green curve for UST is on a linear scale on the right-hand side. It declined from 18.7 billion all the way down to 11.2 billion. So we saw this redemption is about 40% of the supply over that time. Now the red curve, which is the Luna supply, started at 343 million, and it is on a log scale. So every vertical bar here is a factor of 10, going from millions to billions to tens of billions to trillions. So this is linear, this is log, and you can see that this thing essentially went from 343 million and hyperinflated to 6.53 trillion. Now, at this point in time, the Luna blockchain was halted, so these redemptions have essentially been unable to be processed. They're in the process of trying to kick this thing back up and reboot the chain and fork and all the rest of it. But the challenge here is that we've essentially seen the Luna supply completely hyperinflate as the UST was burned. So the more that the Luna price fell, and once we got down into cents, even though UST is worth 12 cents or 7 cents, you're still minting tens of thousands, hundreds of thousands of Luna coins per 12 cent UST. So this thing just essentially went to 0. Now, the talk of the town a couple of weeks back was the Luna Foundation Guard acquiring what turned out to be some 80,394 BTC. So they accumulated an enormous amount of Bitcoin to try and defend the peg. Now, the challenge is, as this thing started unwinding, they therefore had to deploy that BTC. And that also creates a downwards pressure on prices, which doesn't help any coins in the network generally across the cryptocurrency market. When we see the Bitcoin price come under pressure, it actually exacerbated the problems that Luna was having. So hence the hyperinflationary event. Now, as a bit of a deep dive on what actually happened. So you can see that the Luna Foundation Guard has essentially deteriorated down. Well, actually, they have 313 BTC left. So they had 80,394 barely a week ago, and they now have 313. So you can see that they've essentially deployed their entire balance to try and defend the peg, which was ultimately unsuccessful. Now, over the span of about a 21-hour period, they released that BTC in 3 different tranches. The first one was a $750 million lot. Then it was 915 million, 30,000 BTC. And you can see that the gap between these is about 15 hours. This was 6.5. As prices are falling, you can see the urgency of how quickly they tried to unload those coins, and they realized the urgency of the situation and eventually emptied their entire balance. Now, in terms of where did those coins go, you can see that there's 3 blue bars here, which don't necessarily coordinate with where these are. Some of them do, but some of them don't. What we essentially saw is that they transferred their coins to 2 particular locations. And we can see that they all ended up, that 80,000 coins ended up on exchanges at one point in time. The first lot actually went into Gemini, and this was a result of OTC desks. They were providing the coins to their market makers. They were very quickly, you can see this purple spike here on the Gemini balance. They inflowed, and then Gemini repositioned them, got them into the right accounts, and then the market makers essentially distributed those coins to various exchanges. Now, the lion's share of them actually ended up on Binance. Even these ones that initially went into Gemini, a great portion of them actually ended up on Binance, and that was the primary venue for where they tried to defend the peg. And you can see that the Binance overall inflows spiked quite significantly. So we did see a large portion that was kind of the primary venue where all of this action was going on. So at the end of the day, what we've essentially seen is that the UST peg has broken, Luna has hyperinflated, and the Luna Foundation Guard has more or less been left with very, very little left in their balance. So overall, this kind of demonstrates, how market forces can really break these pegs. In many ways, it was, it's an example of what George Soros did with the Bank of England on a miniature scale. But the end result is that we still saw a $41 billion combined project between Luna and UST essentially collapse to a bare fraction of that value. So it shows how these things can in fact unwind. And then even though there is this kind of backing of Bitcoin, in the end, it wasn't sufficient to actually back the peg. And in many ways, it may have actually exacerbated the problem by having to sell that Bitcoin, which created this reflexive loop in an asset that was already reflexive in its pure design. So a very interesting case study, one that if you don't quite understand the mechanics, it's definitely worth studying. Because we do see these kind of algorithmic stablecoins show up from time to time. And this is an excellent case study so you can understand how these reflexive systems to the upside also are very reflexive to the downside. And it's just a simple reality of equal and opposite forces. It's kind of the nature of physics in which we find ourselves. Now, we then saw that this all happened and kind of started on the 9th. Most of the storm for UST, people kind of see the writing on the wall by around the 11th or the 12th. And during that process, we actually saw that the Tether, USDT peg came under pressure. So what we saw is about a 24-hour period where we saw in the green curve here, this is Tether, its price, you can see that it actually dropped down to about 95 cents. And at the same time, all of the other stable coins, I've got plotted here USDC, DAI, and BUSD. These are kind of the other majors. We saw them spike up to $1.01, $1.02. So what we saw is this shifting short-term preference. People moved their value from Tether into these other stable coins. Right now, we can see that over about 24 hours, this actually closed back in. And as of this morning, more or less, all of these stable coins have returned back to their peg. So you can see the difference between this de-pegging event and the de-pegging event that we have here, which has actually continued to deteriorate. So there is a difference between these. Remember that these stablecoins here, with the exception of DAI, fiat backed. There's essentially assets backing them, whether it's treasuries or bonds or commercial paper or just cash. There is a counterparty risk element to it, so they do have different risk profiles. And then we have DAI, which is a crypto over collateralized version. So what I want to explore here is to the different supply curves. What actually happened and what does it tell us about the market moving forward? So let's start from left to right. So with Tether, we've seen about $7.5 billion of redemptions. And you can see this is significant. This is a waterfall of supply redemptions. The USDT supply has decreased. Now, in many ways, the reason why this peg is able to return back to this level is because someone can step in and buy USDT and they feel confident enough to do so at 95 cents, at 96 cents, at 98 cents, and push this thing back towards its peg because they are able to redeem. So we've seen $7.5 billion worth of redemptions happen on the Tether protocol or Tether asset. Simultaneously, we've been talking about this USDC as of last week. It's been in net decline. We've been seeing redemptions happening. This was this capital outflow from the industry since roughly February this year, or late February. Now, we saw during this whole process about $2.5 billion worth of net inflows to USDC. So you can see this actually runs counter to the trend we've had over the last couple of months. So what this is really showing is that we saw $7.5 billion in outflows from Tether. We saw about $2.5 billion in inflows to USDC. Potentially, we have to watch how this evolves over the coming weeks. Maybe a signal of changing preference. Maybe people are starting to prefer USDC. We have to wait and see because Tether remains the largest in the industry. We saw about $1 billion move into Binance USD or BUSD. So all of these kind of showing a bit of a potential changing in preference. Maybe people are moving out of Tether and into other stables. But even if you sum those all up, we've got 7.5 outflows and 3.5 in inflows. So we still saw a net outflow of about $4 billion from the industry, which actually aligns with what we saw last week with USDC. So overall, we're still seeing capital leaving the network. That's the overall takeaway here. However, what we can also take away is that the pegs of all of these stablecoins held vastly superior relative to UST. Now, the other interesting one is DAI. Now, DAI is minted and burned by the Maker protocol. People essentially deposit their Ether or their wrapped Bitcoin or whatever the asset is, and then they mint DAI as a debt position. Now, the only way that that can essentially decrease is the inverse of that, where you have people who are paying off their debt and destroying the DAI or getting forced liquidated. And when you get the amount of volatility that we had over the last week, both of those are likely possible. Generally, given how quickly all this happened, you're going to have some of this portion that's going to be liquidations. So we saw some $2.5 billion worth of DAI get destroyed. In fact, it was so significant, it's about 24%. Almost a quarter of all DAI were essentially burned over the last week. And this is probably a result of some of it being discretionary, but you can see how rapid this actually fell. It's likely there was a lot of liquidations that actually caused this DAI to get burned. So people who had these debt positions didn't expect prices to fall as low as they did. And ultimately, we saw that liquidation of DAI, and their collateral was essentially sold onto the market. Some people would have also paid it off, but sometimes you get these events that happen. It shows that volatility can be reflexive across the entire industry. So now let's look at some of the impacts. What actually happened? How did the market respond? So you can see here that we got these very, very deep net realized losses. Now remember, as prices break below 29,000, which they did as the Tether peg was kind of at its worst, we've now got the entirety of the 2021 and 2022 cycle is underwater. When we got down to the lows, it essentially took prices back to December 2020 levels. So that was as on the rally on the way up. So the entire bull market or bear market, this whole consolidation phase that we've been talking about, was essentially put underwater. We had 2 days of $2.5 billion in net losses, which actually in combination, you can see that it's on a similar scale to all of these major capitulation events. This one here, considering it was 2 days, it was a $2.5 billion, a $1.1 billion, and then another $2.5 billion. If you combine all of these together, very, very significant losses. So essentially the largest we've ever seen in history. Now remember that as Bitcoin gets bigger, we're a $700 billion asset up here, pushing up to $1 trillion at the top end. It's obviously going to be much larger than when we were in 2018 or 2015. So naturally the dollars are going to be larger. So in a way, we have to kind of compare only within this frame of reference. But if we divide that realized loss by the realized cap, we're now basically dividing how much was lost divided by how big the market was. So we're now comparing cycle to cycle. So it gives us a bit more of a relative basis. Nevertheless, what we can see is that the current, I called it the LUNA blowout here, the sell-off that we had here was about 0.28% of the realized cap per day was realized in losses, which is significant. And we can see that the May 2021 sell-off was larger, but same kind of equivalent scale. March 2020 was the angry, very, very angry loss over here. This is, not quite double, but close. The end of the 2018 bear was on an equivalent scale to what we just saw. And the start of the 2018 bear takes the cake in this particular view as one of the largest overall, what we call relative realized losses. But really, I think the takeaway that I want you to have here is that the scale of this is on the same kind of ballpark as what we've seen in the largest capitulations over the last 5 years. So a very, very significant event. We did see that a huge amount, it makes sense when the entire market above is essentially underwater, that flush out is going to have that kind of impact. Now, we did trade down towards the realized price. We didn't hit it. But let me just give you a quick reminder. The realized price is essentially the average cost basis. We look at every coin in the whole network. What was the price that it last moved at? So you take your coin value, 0.5 BTC, for example, times the price when it moved. Let's say it was 25,000 or 35,000. And that will give you, when you sum all of that up, that gives you the realized cap. And then we divide that. So that's kind of the average price when every coin moved. And then we divide that by the circulating supply. And that gives us the realized price. So it's the average price every coin in the network paid for their coins. Now, historically speaking, it acts as a very, very strong support system. And that's because essentially once everyone reaches their cost basis or falls below it, there's a psychological phase to where everyone goes, I'm underwater on my position. That's generally a capitulation style point. We've seen the mass. Most people have essentially sold that we're gonna sell, and you start getting to the point of seller exhaustion. Now, we didn't hit the realized price this week, which was at 24,000, or just below it at the moment. But we didn't quite hit it, but we got within about 9.5% of it. So it got very, very close. And it's important to know that this is one of these metrics that a huge portion of the market, whether they're institutions or retail, is fairly aware of it. Back in 2015, the market generally responded to it down at the bottom, but this is before we knew the realized price and the realized cap existed. 2018 is when it actually got released, and then we had our capitulation event. So we only spent about 4 months under there. When we go and look at March 2020, which was the last time that we hit it, it was about 7 days. So we're getting this compression from 1 year in 2015 to somewhere around 4 months in 2018. March 2020 was 7 days. So the question is, are we going to come back down and revisit it? It's sitting down here about 24,000, as I said, just below it. So it's kind of one of those levels that if we do continue to see this downwards momentum, it potentially is kind of a magnet that's trying to pull price down. But we can also expect, at the very least based on historical performance, that it should provide a reasonably sound support. Now, to really close on that note, actually, I'm going to zoom in on the accumulation score on a 1 year basis here. Now, what I want to highlight here is we've seen this period where, remember, it was kind of intermixed accumulation. We saw a lot of accumulation at the start of this bearish trend. We then saw over the last couple of weeks that a lot of those coins got redistributed. So people who bought up here generally resold down here and redistributed their coins. As we saw, this was where Do Kwon and the Luna Foundation was acquiring, and there was a lot of hype around that purchase side. But we then saw it really weaken. We got these values that were, 0.4, 0.05. I mean, these are very, very weak accumulation. And really, you can see the weakness leading into this sell-off. Now, as we had the sell-off, the values that have been returned over the last couple of days have been significantly strong. This is very, very close to 1. In fact, today's print is 0.999. You almost can't get higher than that. So what we're seeing is that the market generally saw this fall towards the realized price as a value zone. Now, remember, we've seen this bounce back up to the 30,000s. So we're kind of seeing that the market is supporting that bounce. But as we saw through here, let's watch and see how this metric evolves over the coming weeks. We actually want to see this maintain its strength. We want to see the accumulation continuing. We don't actually want to see it, continue to weaken, because otherwise we have a similar scenario to what got us here. So this is a good metric to be paying attention to just understand, does any rally we have from here, or even a sell-off, do investors continue to add to their balance and see value? And this is just kind of breaking down that observation into wallet cohorts. And what you can see is that here's that weak period, right? As we were kind of falling down, this yellow phase we have through here, this is looking at different wallet cohorts. Down the bottom is less than 1, 1 to 10, 10 to 100, and greater than 10,000. You can see this went red to yellow. So we've seen a huge amount of distribution through there, right? People slowed down their accumulation, weakness entered the market. But as we fell, look at the blue that started to creep in. It wasn't all of the cohorts. It was mostly the 10,000s and the less than 100 cohorts. But we have seen that there has been a kind of a change in behavior. And that's generally what we look for. We look for these changes in overall behavior. And this is another one of these metrics that we can continue to track over the coming weeks, and just see how this performs relative to the accumulation score. But you can see the accumulation score kind of captures a lot of this. And remember, this is an important note. The accumulation score has gone into a accumulatory mode, meaning that overall the network is adding to their balance. And this includes, it's offsetting all of the distribution that we know happened, because here's your realized losses. So we know that the Luna Foundation Guard, which is a 10,000 plus entity, we know that they unloaded 80,000 coins. And yet the other folks who have 10,000 coin balances added to and offset that overall distribution. Same here, we had a huge amount of distribution going on, And what we've essentially seen is that those smaller holders have essentially offset a lot of that in terms of the amount of bounce. So it's kind of, they've gone over and above the distribution. So it's just one of those takeaways, but you can see a change in character down here at these lower prices. And this is essentially the fundamental reality of supply and demand. Price corrects until it finds a new pocket of demand, and then we have to consolidate and go through that process again. So thanks everyone for tuning in. Hopefully that was a bit of an overview. It was obviously a pretty chaotic week. A lot happened, some strange mechanisms, stablecoin pegs, changing stablecoin supplies, realized losses, a visit to the realized price, and we've also seen 80,000 BTC unloaded into the market. So a very, very, classic Bitcoin bear market week of complete chaos. So hopefully that was useful for you folks. Please do give us that subscribe. Let me know your comments in the section below, and I will see you next week. Cheers.